Good afternoon, everyone. Warm welcome to the another session by CA Speakers Forum. It had been a long demand to do some IFRS sessions, and today we are back again with IFRS 18. My deep gratitude to our speaker, esteemed speaker, CA Shubham Singla, who will be taking us through this standard in 1 hour's time dedicated for this session. We have a request for IFRS 19 and IFRS 20, which we will eventually look into it and see that how sooner we can accommodate that in our sessions. Now, when we talk about IFRS 18, Shubham will take us through the standard. But one thing what I would like to say that before the standard had been given a name, there was a deep thrust on sharing by the then chairman of IFRS Foundation, ISP board, that they would like to give priority to one project. And the first information or first intention came up in 2016 when it was said that we want to give a priority, and we are in 2026 now. Like 10 years before, we got the first hint that this change is coming. Then in 2019, in March 2019, Hans said about two key projects, and one of them which got shape as IFRS 18, which was called Primary Financial Statements Project. And we are on to that day today that we are in the implementation stage, and from 1st January 2027, the companies will have to mandatorily apply. Some might have already earlier adopted it. And the second thing what he spoken about was management commentary project, which is to reach to a stage where the financial statements are forward looking, where there's something about what's the business model, where people, those who are investors, can easily read the financial statements, what the future may behold, so that they can make the conscious decision of whether they wish to invest in that organization or not. And this management commentary project takes shape from a practice statement, management practice statement, which, if I'm not wrong, was introduced in 2010. And that is getting changed, and it's taking shape, where the draft was issued, but now it is being aligned to sustainability standards. So it may take some time before that goes live. Now, coming back to our speaker and the IFRS 18, our speaker, C. Shubham Singla, he is a qualified chartered accountant. As you see that this is a forum for chartered accountants to speak. He is a rank holder in CA finals, and he is based in UAE, working in a large accounting firm, a reputed consulting firm here in UAE as a manager. And he loves IFRS, and he is a certified yoga trainer. Tomorrow is a yoga day, International Yoga Day. He is a fitness enthusiast, and he is encouraged to speak. Now, before I invite him to speak, I request all of you to please show your love. Let us warmly welcome, use emojis, love, thumbs up, clap. Let us use those emojis and give our warm welcome to our speaker. Thank you very much. CA Shubham, very warm welcome to you. Before I completely hand over the screen to you, I would like to ask you, is there anything you would like to share in 30 seconds or a minute uh, on your expectations from the audience or how you feel and what brought you here? Thank you. Yeah.
Thank you so much, Mr. Prabdeep, for this opportunity, first of all. And I'm really glad and honored to be here sharing my experience with respect to IFRS, which is one of the topics which is very close to my heart.
Right,
And um, what I want from audience is that please be very participative, wherein
right.
if you have any questions, if you have any suggestions, you can let me know, which or any critical feedback in terms of how session should go further session should go. So I'll be very happy to take them.
Thank you. Thank you so much, Shubham. A deep gratitude to you for taking out time on Saturday and being here. The screen is all yours and looking forward to learn from you. Thank you.
Thank you so much. I'll pull up my screen with respect to IFRS 18. Mr. Prabdeep has given a very good background understanding how this standard was formulated, what was the logic behind the standard. So today, what we'll understand is more technical aspects of it, wherein we will understand that how it is changing the face of profit and loss account and how it is going to impact us either we as auditors or as industry professionals. So we'll touch base upon three important pillars of IFRS 18, that how it is going to impact us. So this standard named as presentation and disclosure in financial statements, which is re-architecting the income statement, which is also bringing in a term called management performance measures. In short, we'll call it MPM, and how it is going to impact our cash flow statements as well. Coincidentally, it is going to impact a little bit in terms of how cash flow is being presented. And we will also discuss that how this standard is going to get implemented for all the financials year starting from 1st of January 2027 and onwards. So if any financial statements that we are preparing or auditing starts from 1st of January 2027 and thereafter, they would have to apply IFRS 18. Moving on to the next slide, we'll discuss the agenda for this session. Um, we'll keep it technical related discussions. So first would be that what is IFRS 18 and what it isn't. Second would be that how PNL will be presented. Then we'll also look at one worked example that how you need to do the re-architecturing of PNL from the previous PNL under IAS 1 to the new PNL under IFRS 18. The fourth one would be the management defined performance measures, that how, what, first of all, what is MPM? In short, we'll call it MPM. Then how it needs to be presented in notes to accounts in comparison to the P&L that we'll be presenting under IFRS 18. The fifth would be the impact on statement of cash flows. Sixth agenda item would be a worked example on cash flow statement as well. Then seventh would be some practical challenges from auditors' perspective and from industry professionals' perspective. And the eighth one would be some industry specific pressure points which IFRS 18 will bring into picture or already has brought into picture. Now let's move on to the first slide or first agenda item, which is with respect to IFRS 18. A few points for discussion or for remembrance. It was issued first by IASB in April 2024 to be effective for all the financial years starting from 1st of January 2027. However, it will be retrospectively applied. So for example, if you are preparing or auditing financial statements for the financial year 1st January 2027 until 31st December 2027, so you'll have to present your profit and loss account as per IFRS 18. However, because of the concept of comparability, you would also have to restate the 2026 numbers. You cannot present 2026 under IS 1 with FY27 profit and loss account under IFRS 18. So that is where the retrospective impact comes into picture. So your financial statements of FY27 would have profit and loss account as per IFRS 18 with the previous year profit and loss account kind of restated in terms of IFRS 18. That is what retrospective impact means here. This standard will entirely replace or has already replaced IS1. Now, what are the three pillars of change that will focus in this session? The first one would be the structure of P&L. The second one would be the MPM, which is management defined measures or performance measures, we call it. And the third one would be the aggregation and disaggregation. Now, this standard does not change your profit and loss account. Your amount of profit after taxes will stay same as it was in IS1. It is only the complete revamp of the presentation. So recognition and measurement, the balance sheet structure, the statement of changes in equity, OCI, other comprehensive income, the choice of direct or indirect cash flow method for preparation of cash flow statement, they're all unchanged. Nothing is changing in that respect. IFRS 18 is about presentation and disclosure only of profit for the year, and net cash flows do not move. So what we need to understand is it will not change your profit and loss amount. It will only change how that profit and loss amount is derived from various P&L items. Now, we'll discuss in detail how it is revamping the profit and loss account. So what I would want all of you to remember from this session is that it is going to make 5 categories of P&L items. What are these 5 categories? We are going to discuss in just few minutes. Then there are 2 mandatory subtotals which this standard is also adding to a profit and loss account. Now let's look at what are these 5 categories, and first of all, why this matters. So in IS1, we used to calculate operating profit. We used to calculate gross profit. We had profit and loss, profit before taxes and profit after taxes. But this operating profit that we used to calculate, it was not standard. They are voluntary and they are computed inconsistently. So what this standard is going to do is it is going to make this operating profit calculation consistent. Okay. Now, before we move into the 5 categories, let's first understand a very important term called SMBA. It is also one short form that we should remember. So one short form that we just understood is MPM, which is management performance measures. The second one would be the SMBA, specified main business activity. Now this is nothing very simple term. SMBA is the main core business activity for any business. So for example, a manufacturing entity which is dealing in automobile sector, its specified main business activity would be selling of vehicles. At the same time, for a banking company, its specified main business activity would be giving of loans, taking deposits from its customers. That would be its SMBA. Similarly, in a retail sector, client who's doing sale and purchase of goods, its specified main business activity would be trading of goods. So how this SMBA will going to impact us? It is basically deriving your classifications. So in the left side of the screen, you would see that there are 5 categories in which P&L item needs to be segregated. The first one being operating. So what is operating activity, folks? Operating activity is nothing but derived from this SMBA. So whatever is your core business activity, all the profit and loss items of this core business activity, which is SMBA, will come under operating, which will give us the first subtotal, which is operating profit and loss. Then the second category of revised P&L would be investing, wherein all the P&L item needs to be segregated in investing. Now, if we talk about what would fall under investing, let's think about it. What will fall under investing? Maybe if you want to put in chat box, what do you think would come under investing? Okay, I can see the chats. Interest income, investment in equity, Okay, that's right. So Mr. Surya has mentioned interest income. Yes, it will definitely come under investing. Investment in equity. Yes, if you're receiving any dividend, it will come under investing activity. Now, Deepak is mentioned, Mr. Deepak has mentioned that bank interest income. Yes, that's correct. If your core business activity is not banking, so your interest income would come under investing activity. Then investment in assets, that's right. So glad to see so many responses. So what would come under investing is return from assets held independently. Thank you everyone for answering the question. Now then it will give us second subtotal, mandatory subtotal, which is profit before financing and income taxes. Then the third category for income statement would be financing. Now, what would come under financing would be items related to your financing related line items in balance sheets. For example, if you've taken a loan or borrowing from a financial institution, if you're paying interest expense on it, so it will come under financing activity. Or if you have a lease liability, and as per IFRS 16, if you've recorded an ROU asset and lease liability, so the interest expense basis effective interest rate would come under financing category. So these are the three important categories under the five categories. The fourth one would be the income taxes as per IAS 12. It's the income taxes we all know. It covers your current tax and deferred taxes. Then it will give you profit and loss before taxes, or sorry, after taxes. And then the fifth activity would be discontinued operations. So I believe this so far so good. We have five categories under IFRS 18 in which you would have to present your profit and loss account. The core idea of classification of these five activities would be the SMBA, that is specified main business activity. You would have to present two subtotals, which is mandatory in nature. These two subtotals would be operating profit and profit before financing and income taxes. Okay. Now, why this matters? Operating profit, I'll catch up on this pointer again. Operating profit and profit before financing and income taxes become defined mandatory subtotals. Today they are voluntary and computed inconsistently. That is why it is bringing into picture the IFRS 18. What IFRS 18 is doing is it is right now voluntary and inconsistently calculated, the two subtotals. However, IFRS 18 is trying to make it standardized. All right. Any questions so far, folks?
Yeah, if you have any question, you can raise your hand or unmute yourself. And I don't think Shubham. Yeah, Farzana. Yes, Farzana, please go ahead.
Yes, actually, this is Ali Niaz. How does this
Aline,
work?
yes. Yes.
How does this work for consolidated financial statements? If the business activity of the subsidiary main is different and for the parent is different, how do you do the consolidated financial statements?
That's a very nice question, although we'll be covering it in subsequent slides. But right now, what we'll do is in consolidated financial statements, since you are having multiple subsidiaries, having multiple specified main business activities, so you'd have to allocate that subsidiary is related. I mean, you'll apply the concept of SMBA only. Even in consolidated financial statements, if one subsidiary, for example, has revenue from selling of vehicles, okay, so that revenue from selling of vehicles will come under operating activity. At the same time, if another subsidiary has revenue from loans, interest on loans, that will also come under operating activity, and a detailed disclosure would be required in the financial statements. So it does not mean that you will have only one SMBA in consolidated financial statements. You can have multiple SMBAs, and basis those SMBAs, it will come under operating activity. All right. So the interest expense related to the subsidiary which whose main core business activity is selling of vehicles, it will come under financing. Similarly, but the expense related to deposits for a banking company would come under operating, and
So
that
the
can coexist.
I'm sorry, just a follow-up question, if you don't mind. So this is not based on the materiality of the subsidiary to the consolidated.
Of course, you will apply the materiality concept as well. But right now, to answer your question, if we have many subsidiaries, how will classify the uh, operating, investing, financing, and income taxes and discounted operations? It would be dependent upon the individual subsidiaries SMBA.
Oh,
You
thank
can
you.
bring in the materiality concept as well, and definitely it will be the point of consideration as well while determining the classification.
Thank you.
I have one more question. Income from equity shares and okay. So currency gain and loss, should it be part of financing cost or income? See, it depends from where it is coming from. If your currency gain and loss is with respect to your day-to-day operations, because you have vendors or customers which are overseas, then it will go to operating. Similarly, if it is related to an item which is classified under investing or financing, then it would go to investing or financing. I hope that answers your question, Mr. Munish. Then the next question is, okay, thanks for confirming. Then the next question is it to exhibit the liquidity aspect in line with cash flow? Not at all. That is one buster that will bust in subsequent slides. These categories are nowhere directly linked with cash flow statement. IFRS 18 will be used to determine the classification of these activities. Then the next one is management expense charge to subsidiaries, where we have to show in P&L. See, again, it depends on your SMBA, specified main business activity. So if as a holding company, you are preparing your standalone financial statements, separate financial statements, that management expense charge would be your operating income. It will go to operating category. But when it comes to your consolidated financial statements, it would have already been eliminated. So it will not go anywhere in CFS. I hope that answers your question, Mr. Parag. Perfect. Now, Benazir asks, where can we include the provisions? Again, SMBA would come into picture. If you have created an expense related to your provision for, say, gratuity. Okay, in India, we have gratuity. In UAE, we have um, post-employment benefit plans for which we record expense. So that would go to your operating activity. But if your provisions is related to your financing costs, then it will go to financing. Now we'll move forward, folks, and then we'll cover more aspects of P&L. We have few more questions. We'll catch up with these questions later. Now, this is our pillar one, which is income statement, how it is going to impact it. Now let's look at some worked example. I mean, we should also cover that how it is going to impact our P&L. So this is a worked example, the architecturing of P&L. Now, in the left side of the screen, the left table, it talks about profit and loss account as per IS1, which is as of today. And in the right side of the screen, a very simple example though, but it will make you understand how it is going to be presented under IFRS 18 in the right side of the screen. All right, just please briefly look at the various items under IS1. One is your revenue. Then it is cost of sales. Then we have gross profit. We have other income, distribution administrative expenses. We have finance cost. We have profit before tax. Then we have income tax expenses. And then we have profit for the tax. That's how generally our P&L is made as of today under IS1. Now, folks, we have already discussed that all these P&L line items needs to be classified under 5 headings. And now I would want you to remember by heart. What are these 5 headings? First one is operating. Second one is your investing. Third one is your financing. Fourth one is your income taxes. And fifth one is your discontinued operations. Now, before we dive into IFRS 18, I would like to give you some more background information around this other income. Okay, so this other income has three items. What are these three items? It has share of profit of associate and JVs, which is of 300. Then we have investment income, income from investment of 150, and we have remaining 150 as of the operating income, other operating income. All right. So now we'll first start with operating activity. Now, where would revenue would go? It would definitely would go to operating. Then where would cost of sales would go? Of course, it will go to operating. Then we have gross profit, which is not, which is a balancing figure. It will not be applicable under IFRS 18. Then we have other income. So we have three portions in it. Associates, income from associates. So where would income from associates, all GVs would go? Again, I would like you to answer in chat box, or you can unmute yourself as well.
Investment activity.
Perfect. So it will go to investment activity. Then we have income from investments, where it would go. Again, the name suggests investment activity. And then we have other operating income, where it would go. Would it be classified under operating or investing or financing?
We have to go into it a little bit more in depth to understand what does the other mean.
See, when I add word operating, it automatically means it is related to operations. So it's your other operating income. Right now, prima facie, yeah, that's correct when you mention that we have to go in a little more detail. But prima facie, it looks like it's related to operations, and hence it should go to other operating. It should go to operating function. Any doubts?
Can I ask a question, sir, please?
Yeah, you can.
Okay, one of my subsidiary is in the business of investing in JV and associates. And other subsidiaries or other verticals my business are in also like hospitality or entertainment or leasing or something, right? Now,
Yeah.
I get a share of profit from these associates and JVs. And when I'm putting a consolidated financials, so the share of profits in your on a screen I can see, should this income form part of a revenue or other operating income which is above operating profits, or should this go as after operating profit you have something called income from investments or a share of profits in JVs? So in this case, whatever share of profits I get, where this gets clubbed into?
Right.
Thank you.
It's a very quite a good question you've asked. See, what matters here is the term called SMBA. Specified main business activity. Now, when you say your subsidiary has core operations of investment, now what do you think for that particular subsidiary that income from JVs and associates would be classified into? What it is core operation?
Yeah, should be revenue as per me.
Correct. So for that particular subsidiary, it would go under operating. At the same time, for any company whose main business activity is for selling of vehicles, but they still have done some investments overseas for manufacturing or retail sector. So the income from those JVs and subsidiaries would go under which category? Should it be operating or investing?
Investing.
Correct. So that answers your question. So for determining whether the category is operating or investing, that will solely be dependent upon for that particular entity, whether it is core business activity or not. And the same logic will apply in consolidated financial statements.
Thank you, Shubham.
Yeah. All right. Now, if you look at this profit and loss account, folks, so other income now of 600, which is being presented under IS1 under one line item, is classified under two categories basis the nature of item. One, it goes to operating, the other one, it goes to investing. All right. So now let's look at the right side of IFRS 18 because we have kind of understood that where these items would go. Here in this IFRS 18 P&L, you will show, first of all, you will show operating related line items. So revenue would come first. exactly equal to what we have in IS1. Remember, it is not going to change your profit and loss balance. So here 2060 will remain same in IFRS 18 as well. The only change that would bring IFRS 18 would be the presentation, how P&L would be presented. So first we'll present the operating related P&L items. So first one, revenue would come here, then cost of sales definitely will again come here. Then this operating income, which was forming part of other income, would also come in operating section. And of course, distribution administrative expenses is also your operating activity or operating related P&L item. So that's how you will calculate your operating profit. I hope that is clear. So this operating profit is coming from P&L line items, which relates to your operating category of P&L.
Can I ask a question, please?
Yes, please.
So when you say distribution, so marketing costs will all go under operating activity now? Because earlier, marketing was post-sales activity, post-manufacturing activity that we talked about. So marketing costs like advertisement and stuff like that would actually be in other than the determination of the operating profit. So now you're saying that will determine the operating profit also? The new IAS, it means?
Yes, that's correct. So when we look at operating profit, so this P&L is basically presented under IS1. We had two methods when we used to present our financial statements. One is nature or category, right? Operations. So right now, what we are doing under IFRS 18 is we are trying to calculate our operating profit. Okay. So this operating profit is basically calculated for all your operations. Now your marketing profit, marketing related expenses, your distribution administrative related expenses, they are from your operating activity, and hence it will go under operating profit.
So this is a big shift from what we should do earlier.
Yes, that's correct. But at the same time, please understand that the IS1 allowed us to present financial statement basis nature or function, right? So this nature of, if you talk about nature of expenses, all these kind of expenses were classified basis nature. For example, employee benefit expenses will be under one line item. However, under function method, employee benefit expenses related to your core business activity, related to your manufacturing, was classified under cost of revenue. Then
Correct.
Employees which are related to your marketing goes under marketing and distribution heading.
Correct.
So now here what we are trying to do is we are shifting that from that, and we are presenting under IFRS 18 the operating profit. And operating profit is nothing but your profit from your core business operations related activity. So all those expenses which relates to your business will go under the calculation of operating profit and under the heading of operating portion of your profit and loss account. That is how it is standardizing your P&L. Then, folks, moving forward, if you look at the IFRS 18 P&L, now what was the second heading? It was investing. So what are the line items under the left side of your screen P&L, which will form part of your IFRS 18 investing line item or investing heading? So investing is nothing. So my income from associates or JVs. If my core business activity is not to invest in JVs or subsidiaries, then it will go under investing. If my core business activity is not that. So now my income from investments in associates and JV, it will be forming part of my second classification of P&L line items, which is investing. So this is my operating heading that we discussed in previous slide. This is my investing portion. Now in investing, share of profits in associates in JV, which was 150, it will come under investing. So it will come. I think income from investments, it is 150, it will come here. And your income from associates in JV will come here, which is 300. Then it will give you your second mandatory subtotal, which is profit before financing and income taxes, 3150. Then what we are left with, folks, we have covered revenue, we have covered cost of sales, we have covered other income. We have covered distribution and administrative expenses. Now we are left with finance cost and income tax expenses. It's very clear, very evident, finance cost will go under the third category, which is financing. Then finance expenses would come here 400. It will give you profit before income taxes, which is 2750. It is not a mandatory subtotal, but for better presentation, we do it because the fourth category, which is income taxes, has to be presented separately. So we would have to give a subtotal here as well, which is profit before income taxes. Then the fourth category, income tax expense, would come into picture. You will classify it in the fourth category, and then you will get profit for the year. Here in this example, there is no discontinued operations, and hence there is no fifth category. But if there is a discontinued operations related P&L line items, it will come under fifth category, which is here after profit for the year under discontinued operations.
Shubham,
Yes, sir.
where would the ECL cost come?
Okay. This ECL is related to which line item of balance sheet?
Receivables.
Receivables. Now, these receivables are related to which category?
Trade receivables.
Yes. So trade receivables are related to which category of these five P&L?
Operating.
So the ECL on trade receivables would go to operating category. I hope that answers your question.
Sure. And tax expense, I presume, would also include the movement in the deferred tax.
Yes. So the tax expense includes your IS 12 related tax expense or income. So deferred taxes will go under income taxes expense.
It does not require separate disclosure here on the P&L.
On the P&L, I mean, the way we were presenting income tax expense so far in IS1, there used to have two items here, current tax and deferred tax. That you can also do. This is a very, very simple example. So you can bifurcate it into two portions, which is current tax and deferred tax.
Thank you.
Yeah. So this IFRS 18 is not changing your other standards. It is just reshuffling your items. So if you have to give more disclosures as per other standards, you would have to give them. All right. Let's look at few more questions in the chat box. Impairment of PP&E, our fair value gains and operates. See, Mr. Surya, you have asked question related to fair valuation gains and losses, operating or investing. It depends on which asset you are doing it. If your assets, I mean, just like we have discussed, the ECL on trade receivables would go to operating. Then again, similarly, your investments related fair valuation gains and loss will go to investing. So that's how you will, the concept of SMB will apply for all these items. Impairment of PPN or IP generating main revenue of business is non-cash item. Does this form part of operating profit? Yes, that's correct, Mr. Deepak. It will form part of your operating item. That's what I mentioned. IFRS 18 classification of operating is not equivalent to your cash flow statement. It is different. So even if
sorry to interrupt you. Just to add to here, I mean, when we are talking about the operating profit here, one should not, wrongly misunderstand this as an EBITDA. Am I right?
That's correct. That's correct.
Because when we calculate EBITDA, we add back to profit the impairment portions, which is a non-cash item. So one should not confuse this operating profit here, same as an EBITDA then, I believe.
That's correct. This operating profit is purely related to your business operations. Whatever expenses, whether cash, non-cash, it will come under operating profit calculation.
Right. Thank you for that. And secondly, I mean, IFRS 18 talks of anything to disclose on a EBITDA number in a statutory financials.
Yes, if you want to disclose it as a management performance measure, so there is a separate slide that we'll talk about. You can disclose in notes to accounts your management performance measures, which is specific to your company.
Okay, thank you.
Yeah. Folks, due to the
I have a question.
Yes.
My name is R.K. Mehta.
Yes, Mr.
We
Mehta.
discussed about, let's say if we have a subsidiary, and that subsidiary's core business is to invest in investments and associates in other subsidiaries, whereas the holding company has many other businesses. So the subsidiary will show income and as core business under your SNBM.
Yeah, that's correct.
Whereas the holding company, the holding of this investment on subsidiary is a very tiny fraction. So the income that flows from the subsidiary into the holding company, where will that get classified? Because for the subsidiary, it was operating income, but for the holding company, it should be as an investment income. So there's a reclassification there.
Sir, the intercompany entries will be eliminated. So, for example, if you're paying dividend, your subsidiary
No,
is paying.
there's an income from further investments by the subsidiary, does investments and associates. So it will not get consolidated, not get eliminated.
Yes, if it is not getting eliminated, you will apply the concept of SMBA on specific subsidiary level. Okay. And when you're preparing consolidated financial statements, you would have to again apply the SMBA concept from that subsidiary perspective. So if your subsidiary which deals in your investments, its business income, its income, for example, share in JV or share in associate, will be classified under operating portion in the consolidated financial statements. Similarly, your other subsidiaries whose business is different, revenue earned from that subsidiaries will be classified again in operating income. If it is material,
So
if it is immaterial, then it doesn't matter.
understood. Okay, thank you.
Folks, for the benefit of time, what we'll do is we'll cover the remaining portions of the slides, and then we'll take the questions. So this is the worked example. This is kind of made us understood that how your P&L structure will change. Now, the second is management defined performance measures. Someone in the audience asked that can we disclose EBITDA in the IFRS 18? The answer is yes. However, first we need to understand the concept of management defined performance measures. So MPMs, we'll take few examples. Okay, that what is an MPM, what it can be. So one is EBITDA, or it can be other measure. For example, average revenue per user. We have seen this term average revenue per user in telecommunication sector, wherein the companies present that what is average revenue per user they are earning. Then there is another MPM for, say, for example, for this online retail sector companies. For example, we have Noon here, okay? We have Amazon. So what they do is they need to understand what is average order size per order. So this is also a management defined performance measure where they show that from last year their average order size is increased. So there can be multiple management defined performance measures basis industries, and companies want to present them. They have been doing it for many years. However, this IFRS 18 standard only talks about two mandatory subtotals, which is your operating profit and your profit before income and taxes. Right, we have just discussed here operating profit and profit before financing and interest and income taxes. Now, how do we present these industry specific management defined performance measures? So IFRS 18 says that yes, you can present them, but how do you present them? You present them in a single note. So first of all, what you will mention is why the measure is used and how it gives useful information. So for a telecommunication sector, ARPU, average revenue per user, is a measure that they have been presenting for many years in their existence. So why this is important, you have to mention it in note. Then a reconciliation to the most directly comparable IFRS subtotal. IFRS 18 has five mandatory categories and two subtotals. So what you will do is you will take the relevant subtotal from your IFRS 18 P&L, you will present a reconciliation and then you will present that management defined performance measure. So for example, for EBITDA, what you can do is you can take this management defined performance measure, which is profit before financing and income taxes, prepare a reconciliation that from how 3150 and EBITDA is being derived. And then you present it in the notes to accounts. Then income taxes and non-controlling interest effect of each reconciling item. Whatever you are presenting, you need to present its income taxes and non-controlling interest effect of each reconciling item as well in the notes to accounts. How the measure is calculated, we've already covered it though in the second part, and changes in method with reasons. If you have changed the methods, how you're calculating MPM from previous year, you will have to give a disclosure as well. And the fifth one, last one, is a statement that MPMs are management's view and not necessarily comparable across entities. You would have to give the disclosure that this is industry specific or company specific management defined performance measure, and it might not be comparable with other MPMs of other companies in similar industry or different industries. So that is how you will present a separate subtotal, which is not part of IFRS 18 in a separate notes in notes to accounts. How it is going to change us? What changes here from auditor's perspective? Audit scope expense. We would have to understand how this MPM related disclosure has been prepared by management. We would have to audit it. So MPM sit inside the financial statements. They are now within the audit opinion, not just alternative performance measures reviewed lightly. Consistency should be there. You should calculate your MPMs consistently over the years. It's not like that you keep changing it every year. But if you're changing it, you would have to give a reason why you are changing it. And governance and controls are also brought into picture. Entities need a defined inventory of MPMs, owners, and a control over the reconciliation. Many do not have this today. How you are calculating MPM? You would have to have governance and controls around the calculation of MPM. All right. I'll take a pause here. You can mention your questions in the chat box, which we'll take later. Now, the third pillar under this standard is aggregation and disaggregation and the end of vague lines. Now, we all know that a lot of items, immaterial items, go to other income or expenses. We have just seen before as well. This other income had many line items which were classified into operating and investing or maybe financing as well. This aggregation, this standard is bringing the end of vague lines. You would have to relook at your P&L line items. You would have to classify your P&L line item. You would have to aggregate and disaggregate them basis the SMBA concept and basis the category in the IFRS 18. So principle, what is the principle here? The group items into line items by shared characteristics and separate items whose characteristics differ. That is aggregation and disaggregation concept. Useful structured summaries belong on the face, supporting details belong in the notes. Materiality decides where the line is drawn. Now, operating expenses are real choice with a catch. Why? Because present them by nature or function or a mix, whichever gives you the most useful structured summary. You would have to do it, the aggregation you would have to do it basis nature or function. The catch here is, if any line is presented by function, that is cost of sales, you must disclose in the notes the specified expenses by nature, which we are doing already, right? So for example, if you present your P&L basis function, okay, so your employees related to your manufacturing will go to your cost of sales. Your employee benefit expense related to your marketing goes to your distribution and marketing related expenses. So what we do is we kind of give in notes to accounts what cost of sales consists of. For example, it consists of inventory cost, it consists of employee benefit expenses or whatever. So this is what we have been doing already. However, what this standard is trying to do here is it is ending the vague lines. It is trying to make you think again when you're applying IFRS 18 that all the items which you have segregated, disaggregated, it has to be done basis the concept of SMBA and the 5 pillars or the 5 broader headings that IFRS 18 is bringing into picture. That is what this pillar 3 is about. All right. So the other bucket is on notice. Catch all captions are curved. Where a residual line is material, you must describe what sits inside it. You would have to do separate classification again. Disaggregate dissimilar items. You cannot club all the expenses under other expenses just because you cannot decide which category it falls into. You would have to do that classification. You would have to put them under specific headings to be classified under 5 headings in P&L as per IFRS 18. And notes may you would have to give a detailed understanding that what actually sits under cost of sales or your distribution and marketing expenses or whatever. So in notes, you would have to do more you would have to give more information, which we're already doing as well. I mean, it's not something which we're not doing, but here what we're trying to do is we are ending the vague lines. We cannot club everything under other expenses and keep it in P&L. I think this is one of the last slides, which is little heavy. And then we'll have 2 more slides wherein we'll cover the, we'll discuss the remaining aspects of the P&L. So how it is going to impact our cash flow statement? See, cash flow statement is not going to get impacted. The only material change which is bringing into picture, I'll take you first to the next slide. So the under cash flow statement, before we used to start with profit before taxes. Okay, that's how we used to do it. Generally, we used to start with profit before taxes. Now, what the standard is trying to do is, now you prepare your cash flow statement for operating activities starting with operating profit. That's one change which the standard is bringing into picture. So in the left side of your screen, you see that how do you calculate your cash generated from operations? You start with profit before taxes. But how do you calculate your cash from operating activities in the IFRS 18? You start with operating profit. Now, if you look at the way of calculating cash from operating activities, it has become more cleaner and leaner. Why? Because you start with operating profit. So it will automatically will not have your finance related portions. It will not have your investing related portions. So your your interest income or expenses, your other income related to your investing activity will be excluded while calculating this operating profit, because this operating profit, from where it is coming from, I'll take you to the previous slide. This operating profit is coming from here, so it does not include your investing or financing related portions already. So your cash from operating activity calculation would become little leaner and clearer. How it has become leaner and clearer? Let's again look at it. So in the right side of the screen, you see that we are supposed to add back only 2 items: depreciation, amortization, and working capital changes. However, in the left side of the screen, since we started with profit before taxes, we would have to add back finance cost. We would have to deduct our investment income and share of associates. Why? Because we started with profit before taxes. So these investing and financing related P&L line items were supposed to be added back or reduced from profit before taxes to calculate our cash generated from operations. That's the only major change the IFRS 18 will bring to your cash flow statement presentation. I hope this is clear. All right. Now, folks, coming back to this slide for impact on statement of cash flows, we've already discussed. Now we have a single defined starting point. Before that, we didn't have any single starting defined point. Some companies used to start with profit before taxes. Some used to start with profit after taxes even. Okay. And then you would have to start it. But now there's a single defined starting point for cash flow statements under IAS 7 that you would have to take operating profit for its calculation. Now we had a free choice while preparing cash flow statement under IAS 7 along with IAS 1. So the interest and dividend free choice is gone now. So for non-banking company or non-financial institutions, interest received will be investing activity now. Previously, it could have been operating or investing, but now it is only investing. For again, I'm using word non-financial institutions. For interest paid will always be financing activity. Dividends received will always be investing activity, and dividends paid will always be financing activity for a non-financial instrument. Of course, for a financial institutions, interest received would be operating activity or will be classified under operating. So this is how.
Can I ask you one question? Sorry. For financial institutions, we understand that interest income is operating activity, and they have to say derive at operational cash flow, net operational cash flow. That net operational cash flow is nothing but interest received less interest paid. So by this logic, the finance cost what they pay will be an operating item for financial institutions, right? It will not always be non-operating.
That's correct. So again, we would have to look at that what kind of what kind of core business activity the company is. For financial institutions, it's operating activity or operations related expense, and it has to go to operating category of P&L. So below, if you see entities with an SMBA, that is banks, insurers, certain investments and real estate entities, classify these in a single category consistent with their main business, frequently operating. Net cash flow is unchanged in every case. So even in the next example, you would say that the cash generated from operations under IS 1 era would be 3250, and again in IFRS 18 would be 3250. Your cash from operating activities will not change. The way you calculate would change. That the starting point here is now operating activities. Previously, it was profit before taxes or profit after taxes. It was not defined. All right. Now we will cover two more slides. The first one is practical challenges for companies, for preparers. They would have to revamp their chart of accounts and systems. Why? Because the chart of accounts previously in IS1 were not classified as per the 5 broader headings right now we have. So they would have to revamp their chart of accounts and their IT systems as well. They would have to map every GL code, what sits in GL code basis the broader 5 headings, so that their P&L which is coming out from their IT systems is accurate. Restated comparatives. Every company would have to restate their 2026 numbers of P&L into 5 categories that we have discussed. The covenants and remuneration. If your director's remuneration of your loan repayments are related to your operating profit. Now, since your operating profit calculation is changing, it might impact your covenants, compliance, and remuneration for your top employees. Hence, you would have to relook at the covenants and remuneration. And if you want to do some changes, you would have to do that. MPM governance becomes important because it will be audited. It will be forming part of your notes accounts. Auditors would have to do the audit of these numbers, and hence how MPMs are calculated would need to be clearly defined in the companies. And investor communications should have to be done, because now your operating profit calculation is standardized. You might be including or excluding few items before, and it might change your previous year's in operating profit, or it might impact it. So in case it is impacting you as a company materially, you would have to do a better investor communication so that there are less follow-up questions. So preempt the narrative, explain why headline operating profit has moved before analysts do. And for auditors, it's classification judgment, that how you classify under operating, investing, financing. MPMs now in scope of audit, aggregation and meaningful labels, restatement and opening balances. This is important. Why? Because you would have to present that how your P&L of previous year of 2026 has been presented under IFRS 18. So there would be an added disclosure under IFRS 18 in the financial statements for the first year, where you would have to present your P&L as per IS1 to as per IFRS 15. So this what we did here in this slide. You would have to present it in such a way that a user can understand how this particular line item in other income of 300, 150 and 150 went into the IFRS 18. You would have to give that detailed disclosure. So this is from auditor's perspective, how it will change. And the last one is controls over new processes. How companies are maintaining controls over the new classification in their IT systems. And the last important slide is with respect to industry-specific pressure points. Is it fine, Mr. Prabhdeep, if we extend for 5 to 10 minutes?
Yes, Shubham, we can extend by 10 odd minutes.
All right. So now this is industry-specific pressure points. For banking and financial institutions, interest and trading is the business. As we have discussed, an SMBA keeps these in operating. Drawing the operating investing financing line is the core judgment. Okay. For real estate and investment property, rental income and fair value movements, where it would go? It would go to operating rather than investing. Why? Because their core business activity is investment or investment in properties. So all the items of P&L related to your investment property or your inventory would go to your operating rather than investing. Now, for insurers, how it will impact interaction of IFRS 17 results with IFRS 18 categories, right? So IFRS 17 is for insurance companies. IFRS 18 will have to be compliant as insurance company will have to be compliant with IFRS 18 as well. So how IFRS 17 interacts with IFRS 18 is something which insurance companies would have to understand. Insurance, finance, income, expense, and investment returns must be slotted consistently. So they would have to understand from IFRS 18 perspective what goes to operating, what goes to financing or investing. Now, for diversified conglomerates, this was very much asked question even in previous slides in the initial start of the session. So multiple main business activities under one roof, entity level SMBA, judgments and split classification policies. So the important word here is split classification policies. You cannot say that my SMBA is this only and hence I'll classify all the income related to this SMBA in operating and remaining will go to investing or financing. No, you would have to apply a split classification policy for a diversified conglomerate. Yeah, there are two more remaining. Capital intensive telecom utilities and infra, large depreciation, leases and borrowings make the operating versus financing boundary and the new cash flow start material. So when we have capital intensive industries, which we have in which we have leases as well, so a broader understanding is required that what goes to operating, what goes to financing, and where the depreciation would go. Investment entities, PE and holdco companies. This was also one of the very important questions being asked in the previous slides, that how we would classify the investment entities profits and losses items of P&L. So returns on investments are the business. Here the key word is, again, the SMBA is the main aspect. So returns on investments are the business, likely operating under SMBA, reshaping subtotals investors rely upon, right? So these are industry specific pressure points which would have to be aware about. Now this is, I think, this is the last slide of our session, a transition roadmap. We've already kind of discussed it, but we'll cover it in a one slider as well. So now we are assessing, now the company, although it was in 2025 as well, the companies were assessing that how their IFRS 18 P&L would look like. Map income and expenses to the 5 categories, run the specified main business activity test, which is SMBA test, and inventory external measures that meet the MPM definition. Build in FY26, build the comparatives as well, then report first close of FY27. That it will go, and then fourth step would be ongoing, which is embedded in subsequent financial years. That is ongoing. So this is how folks we have understood in this session. What we've understood is presentation, not measurement. It is not going to change our profit. It is only going to change how P&L is presented. The second thing is two defined subtotals are mandatory, which we've understood is operating profit and profit before financing and income taxes. Third one is MPMs enter the audited notes. It has to be presented clearly. And fourth one is IAS 7 changes, which are easy to miss. I mean, who could understand that how IAS 7 change would be, IAS 7 presentation would be changed due to IFRS 18. Why? Because in IAS 7, there's the starting point would be now operating profit rather than any voluntary measure, which is profit before taxes or profit after taxes. All right. So this is it, the closure of our session.
Yeah, thank you.
I again thank you, Mr. Prabhdeep, for this opportunity, and I hope I could make some value addition to our fellow folks' knowledge.
Thank you so much, Shubham. A wonderful session. We can give a couple of opportunities maybe for questions. Yes, Ali, you
Yes.
have unmuted. You can go first. Yeah.
Yes, thank you so much, Bob. It was actually a wonderful presentation. Very happy that you made this presentation. One quick question. When you talked about the industry standards, we didn't mention oil and gas. So are there any specific oil and gas requirements that are applicable in terms of I mean, how do we define the standards there?
Yeah, so actually IFRS 18 is not specific to any industry. The only thing that would matter is SMBA. If your main activity is falling under oil and gas sector, so your SMBA will come into picture. All those expenses and income which falls under that activity will go to operating, and other would be classified under financing and investing.
Okay. I leave others to do it. I think there are a lot of questions for others also.
Thank you. Thank you so much. Yes, anyone else would like to take this opportunity to ask the last question? Yes.
Sir, I would like to ask the
Yes.
question on
Yeah.
this. This was about the presentation of the cash flow, where you said that it has to start from operating profit and then we add back depreciation and working capital changes. You had only put the grossed up figures of the working capital. Can we exhibit the cash flow in the same way as line by line, or just for presentation or illustrative purpose, you specified as working capital changes?
Yes, that's correct. It is a very brief presentation. You are
Okay.
right to say that. Nothing will change in terms of how working capital changes will be presented. Yes, you can present as changes in trade receivables, changes in inventory, changes in cash and cash equivalents, although it will come down, but everything
That
will
is, a
stay.
detailed breakup can be given. The detailed
Yes.
breakup can be given line wise.
Yes, that's
That's all.
correct.
Okay. That's all. Huh?
Yeah.
Yes. Thank you. Thank you so much, Shubham.
I have one final question, if you don't mind.
Yeah. Okay, please.
It's not related to IFRS 18, but I just want to ask whether Shubham Singla, are you related to Noor Singla?
No, sir, I'm not related to her.
Okay.
But
That
we
was
share
just
the
on a
same
lighter
thing.
note. Thank you very much.
Thank you. Thank you so much.
Yeah, Shubham,
Yeah.
IFRS for SMEs is not impacted by IFRS 18, right?
Sir, I would have to look at it, but right now, as per my understanding, it is not impacted.
Thank you.
Okay. Thank you. Thank you once again. Thank you, Shubham. Lord, it has been a really very valuable session, and I can see that the participants were very attentive and they had so many questions, and they have already shown a lot of love and gratitude to you for your session today. And I request everyone, before we sign off, if you would like to express your gratitude to Shubham, please do that now. And any last message, Shubham, you have before we end this call?
Thank you so much, everyone. As I've told before, IFRS is something which is close to my heart. I used to teach IFRS for diploma IFRS as well, and
Right.
it comes very comfortably for me to teach. So further opportunities with respect to IFRS or any UA related matters, I would be very happy to take them, Mr. Prabdeep. And
Thank you.
I am an AI enthusiast as well. I understand advanced Excel and Power BI and various AI tools. So I would be happy to take sessions on advanced Excel as well.
Thank you. Thank you. Thank you so much, Shubham. We have a AI session on July 1st and also on July 25th, and we'll connect with you also on that. And next Saturday, we'll be meeting for international taxation, cross-border taxation in UAE. And request everyone to be back here. Mostly we'll meet at 11 a.m. on Saturday. And have a great weekend. Thank you so much, Shubham, once again. Great weekend to everyone. Take good care of yourself. Have a wonderful day. Bye-bye.
Thank you. Bye-bye.
So, in fact, Saturdays are something which are not to be missed. If Pradeep sir is conducting a workshop or anything of that sort, as far as the accountancy profession is concerned, it's really